Chapter 6, the challenges of accounting. We're going to look at standards, internal controls, audits, fraud, and ethics. Now this chapter, we're not really working problems. We're actually just looking at some of the overall issues associated with accounting, i.e., do we do everything the same way? Do we have controls to make sure there isn't fraud? Who audits a company? Usually it's a certified public accountant, also known as a CPA. What are the legal responsibilities of that accountant? And then a look at book value versus market value. Now, understand the important use of GAAP and how it differs from the accounting standards in other countries. And that's the International Financial Reporting Standards. Now, the U.S. accounting standards are designed to produce financial information that is understandable, relevant, and reliable. The Financial Accounting Standards Board determines the standards used in the United States, where accounting standards are conservative and report most information, and we use historical costs except for investments. Accounting standards differ around the world because of difference in culture and law. Many countries use accounting standards issued by the IASB. Now, there at one time was a goal, started about 20 years ago, to try to combine the IASB and FASB. That all fell apart, and they finally gave up about 5 years ago and said this is just never going to happen. So there's the internet, although they did change a lot of the GAAP standards to more coincide with the international standards, we're still not the same, and that's not going to change. And primarily because under the FASB or GAAP, we are rule-based. We have rules for everything. And our goal is for financial reporting is to investors and banks. The IASB, there is a lot more subjectivity in their rules, but the standards are set by lawyers and banks, and accounting doesn't play the same role that it does in the United States. So, what are the rules that govern accounting? Well, first of all, the goal is to make it understandable, reliable, and relevant. Now, US GAAP, we consider ourselves conservative, tries to not overstate values, whether overstating the value of an asset or understating the value of a liability. Being conservative, accountants use historical costs to report assets, liabilities, and stockholders' equity. And when market value of an item permanently drops below the historical cost, U.S. accountants adjust the value to reflect the lower market value. When the value of an item increases, U.S. accountants generally do not increase the value of any item, except when it comes to marketable securities. That increase in value would be recognized only if the item were sold. Now, that's much different than generally accepted accounting principles or the international standard, the IFRS. Now, the International Accounting Board is the international organization developing and promoting accounting. It's more of a guide. There's not a lot of rules. The International Financial Reporting Standards are accounting standards developed by the IASB for use throughout the world. The United States has decided not to adopt the international standards. Countries that have adopted some or all international standards, including European countries, Canada, Mexico, China, and Russia. And the thing is, they have a lot more flexibility under the international standard than they do with GAAP. Of course, the problem with GAAP is, since we're rule-based, we're always looking at ways to get around the rules. Now let's take a look at internal control. What we're looking at here is a comprehensive system that helps an organization safeguard assets, operate efficiently and effectively, and ensure proper reporting of financial information, and ensure compliance with applicable laws and regulations. That's the goal. Now, internal controls. What's the primary focus? We want to safeguard the assets, ensure compliance with laws, ensure proper reporting of financial information, and are we operating efficiently and effectively? Now, what do we do when we look at them? Well, first of all, what does it mean when they say we have to have a control environment? Well, it means leadership's philosophy and operating style, the competence of the employees, the integrity and ethical values of the company. It's the general rule. It starts at the top. If you have management cheating, that doesn't bode well for your employees. Risk assessment is the process of identifying risk and taking steps to mitigate them. An example would be, you do not want to have the same person do the accounts receivable and the accounts payable. You leave yourself open there. Control activities are the policies and procedures. Two elements are related to control activities: policy establishing what should be done, procedures that should be followed to implement the policies. Information and communication to maximize the effectiveness of internal control. Information about the controlled environment, the risk assessment, and the controlled activities must be communicated at all levels. Monitoring the internal control system must be continually monitored to locate weaknesses in the system. Now, the big problem that you have with internal controls is, particularly for a small company, how much are you willing to pay in order to have these controls? Because usually at a small company you have people multitasking, and that's a lot of times where you get in trouble. The goal is not to make it too easy for people to steal, because they will. Fraud is deception or trickery of personal gain. Many types of fraud exist, but in the business world, fraud is committed by a business or against a business. For fraud to occur, there must be perceived pressure, rationalization, and perceived opportunity. And that's how we get to the fraud triangle. So we start with perceived opportunity: weak internal controls, ineffective monitoring of controls, assets susceptible to fraud. So an individual who commits fraud must perceive that an opportunity exists to commit fraud, conceal it, and avoid punishment. A good example would be if you have a petty cash box. If you don't make one person responsible for it and anybody can go in and they don't have to give receipts, you're leaving yourself wide open. Or if you have goods that are easily sold, then what you want to do is keep them in an area that's fenced off that not everybody has access to. Now, rationalization is finding good reasons for doing things that we know are wrong. And perceived pressure. The most likely source of perceived pressure is usually financial pressure or work-related pressure, i.e. they're dissatisfied with their job, they don't think they're paid correctly, they have addiction, or they need cash. Now, the next thing we're going to talk about is certified public accountants. This is in the United States. In order for you to be a certified public accountant, you must pass a very challenging exam, 4 parts, and then you must be, they have different levels of being a CPA. Okay? Actually, it's a lot easier today, once you pass that test, to be a CPA. Now, CPAs provide different kinds of audit opinions. The one you want to get is the unqualified, i.e. that means, to the best of their opinion, everything looks fine. A qualified opinion means, well, everything's fine except. Adverse means that there's problems, and that is very bad for anybody that gets an adverse opinion. And disclaimer means they're saying we can't attest to anything that's going on here. Now, the last thing we're going to talk about is book versus market value. The book value of a business is normally assets minus liabilities. That's the net book value of a company. That is usually not the real value of a company. It tends to be more, and how much, when you're looking at how much is a business worth, it's not usually the book value, because again, we have a tendency to say, for instance, we bought a building for $1 million 30 years ago. We may have fully depreciated that, and it may be worth $30 million today, but on the books, it would show 0. So that's when we're talking about, when we look at this, we're talking about market value or market capitalization. Market capitalization is the current market price per share multiplied by the number of shares outstanding. And that concludes this presentation.